Good afternoon, everyone. Welcome to Fairway Wholesale Lending's presentation on USDA lending. I have a little after 2 right now, so we have 50 plus attendees and joining right now. So we'll give just another minute while I kind of give the intro into our presentation before we get started. Number one, we appreciate you taking some time today and learning a little bit about USDA lending. Number 2, thank you for your partnership. You're the lifeline of our business here at Fairway Wholesale Lending, and we take our relationships seriously and hope that your experience with Fairway is consistent with what we strive to provide you. An unmatched customer experience from start to finish. And we live in an imperfect world, but through your feedback, through your discussions with your account executives, we hear opportunities that we can improve the platform, and we're always committed to constant improvement of what we do. So make sure you do communicate those things, process improvement. We're always trying to do what we do better here at Fairway, and your voice is a big driver of how we do that. So again, today we're going to cover USDA lending. A couple things, just reminders to you. You're in listen-only mode, which means that we can't hear you if you talk, or the audience cannot hear you if you talk. So we will stop a couple of times, and I'll ask Allie or Christy if we have any questions in the queue. If you'll notice on that GoToWebinar screen, there's a chat box or there's a question box. If you have questions on anything that we cover, anything that we say, just type it in there. Again, we'll stop a couple times throughout the presentation. A couple folks joining us on this call that you'll hear from today. Greg Reynolds, our underwriting manager. Brenda Martin, one of our underwriting team leads here out of the Birmingham office that handles a lot of USDA business. We got Christy Rich, formerly Christy Canodal, who does a lot of our onboarding and training sessions. Allie Driscoll, one of our marketing specialists, Judy Brooks in the production here out of Alabama, and Lonnie Dixon, who oversees our operations. So we're going to be covering a lot of information today. Rest assured that you will get these handouts once we finish this presentation today. Everybody that attends will send out the slide deck and contact information. So we recently participated in-house with a local USDA office, actually one local to our Chicago ops office, and we had them do some training for our internal staff and our AEs for some of our ops team. And so we've taken a lot of information from that presentation, and we're sharing it with you today. There's overload of information on the slides. We're going to stay at high level, but we felt it worthwhile to keep that information in those slides, that when you go back to the slide deck and you've got some really good reference information, a lot of this is either from straight from USDA or out of our guideline engine. So today, the objective of today is to arm you to close more loans. As we know, 2017 was different than 2016. Every year is a little different. The cycles of the market, dictate changes by originators. And 2017 was one that we came into the year, in a rising interest rate once the election took place in November. So we came into 2017 with a rising interest rate environment, which we had a good pipeline of refi business that kind of closed its way through the pipeline by March. March of this year, the environment as a whole, the industry as a whole, shifted to a purchase market first. And that made some changes, particularly with the wholesale side of things. A lot of our broker relationships did a lot of refi business. We've watched a lot of you redefine yourself in a very short period of time. And if we look back at what Fairway Wholesale Lending has tried to do throughout the course of the year, it's really arm you to close more loans. We started the year with talking about best practices, getting you focused on closing loans quickly. We're happy to let you know that we're doing away with a 21-day closing game plan and really say close as fast as you want. The quick close game plan, we're rebranding ourselves. We see that 21 days is good. but yet some of you have told us we need to close quicker than 21 days. It's all relative and predicated on how well the file comes in and how on top of the conditions you are. We feel very, very, very confident about our service levels and enabling you time and time again to close loans in less than 30 days. We want to put you in a position where you have a competitive advantage in your market. So if we look at the changes in the market, really focusing on the purchase business, every time you have a change, there's opportunity. And that's what I look at it as far as the direction that Fairway goes. We're always trying to look a little bit down the road, a little further than 90, 120 days, and say what changes are occurring. We've got some. If you look down into 2018, you got a couple changes, HMDA changes and loan application changes. How do we position ourselves to take advantage of those opportunities? Well, this year was all about understanding that the dynamics of the market. Share a stat with you right there. 61% of first-time home buyers are the ages between 18 and 34. Think about that. That's the millennial generation. We all heard about these millennials, but when you think about that, it's kind of reminding ourselves that we got to cater to high loan-to-value lending programs, low to moderate income borrowers. Think about that first-time home buyer generation, the 18 to 34. And some of those guys are just coming out of college and just getting their first jobs. When we get up closer to 34, maybe they've saved a little money, but it is high loan-to-value lending programs. So we started the year again trying to arm you with the ability to close loans quickly, and then as we've gone through the year, we've progressed. We've talked about VA. A couple months ago, we did two different VA sessions, a high-level session and a deep dive. And we spent a little time on Fannie Mae Home Ready and Freddie Mac Home Possible, and talking about some of the LPMI flexibility you have with those products. And so today, again, just continuation of that focus and arming you with trying to do something a little different, trying to add to your arsenal, trying to enable you to close more loans. Let's talk about USDA / rural development. So, the program, as far as the definition and the objective of the program, it's all about affordable home ownership in rural development, rural areas, creating communities and improving the quality of life in rural areas. Great program for the first-time home buyer, but it does not have to be a first-time home buyer to be able to be eligible to do the USDA program. So that's kind of their mission, is low to moderate income borrowers. We realize the typical USDA borrower is somewhat in line with the typical FHA borrower, and the Fannie Mae Home Ready and the Freddie Mac Home Possible. It's all that high loan to value, low to moderate income borrower. When you look at what the program is, just talk about some high level highlights of the program. We got a minimum 620 credit score. You can go up to 100% loan to value. In fact, you can exceed that in instances where the appraised value allows you to do so. You do have an upfront guarantee fee, which can be rolled into the loan amount, again, exceeding 100% loan to value if our value allows for it. Maximum of 6% seller concessions to use closing cost prepaids, 1 units. Escrow holdbacks, what we're talking about is repair escrows. That's something that Fairway allows you to do in just about in conjunction with just about every agency program. But it's typical in USDA lending that we're going to see a property that has some cosmetic repairs, that has some repairs that are necessary to bring it up to livable conditions. So we do allow for repair escrows to be used in conjunction with the loan program, include closing costs, repairs in the loan amount, down payment assistance, gift funds. So that, if you never did USDA lending before, you did FHA lending, you say, okay, this is kind of in line with a lot of that. What are some unique elements of the USDA product? And this is from my perspective. We got to know that there's borrower eligibility requirements, okay? And those aren't so strenuous. again, every one of these is a section we're going to dig into deeper later in the presentation, but there are borrower eligibility requirements. It's got to be a U.S. citizen. Again, it doesn't have to be a first-time home buyer. This program is great for first-time home buyers. Property eligibility. The property has to be located in an area that is eligible for USDA lending. We'll look at a map later on in this webinar, and you'll see, surprisingly, that most of the areas that our broker relationships are in, once you step outside of that primary MSA, almost all of those areas are eligible for USDA lending. There is an income eligibility, and really what we're talking about is income restrictions. Okay, household, there's maximums on the household income. Credit eligibility. So USDA, a little different than most of the other agencies. They do not use, USDA does not use Fannie Mae's DU engine, desktop underwriter, or Freddie Mac's LPA. It uses its own underwriting system to assess the credit quality and credit eligibility of the loan. It's called GUS, which we'll refer to it today. There are guarantee fees. This isn't necessarily unique to USDA because all these high LTV, with the exception of the Fannie Mae Home Ready and Freddie Mac Home Possible, there's some kind of guarantee fee, and as you see right there, 1% upfront fee with a 0.35% annual. Okay, so it's kind of that hybrid. We have an upfront with an annual, monthly guarantee premium. Sorry. And then this is truly unique to USDA because there's not another loan program out there that follows the workflow of the USDA program, in that there is involvement of the local USDA offices. Once we approve the loan, we send it up, we package it up, send it over to the local USDA offices for them to review it and issue their conditional commitment. So very high-level elements that are unique to USDA lending that you need to know about. If you're going to be performing USDA loans, you need to know what all these things mean and how it impacts your business. Okay, process flow, again, slightly different than most of our other business, actually than all of our other business. You're originating a loan, we're running it through GUS, you're processing the loan, you're submitting it to us. Once we issue the approval, we're transmitting that loan to the local rural housing office, who then comes back and issues a conditional commitment, and then we can close the loan. So one little element, one more element to factor in when we're talking about process flow and cycle times. You need to know that cycle times of the local rural development offices vary nationwide. There's some offices that sorry, go ahead, Blake.
Sorry, yeah, I keep talking over you. To clarify, we can't send that loan to USDA, the local office, for their issuance of the conditional commitment until we have all the conditions in the file. We don't transmit to them at the time of approval. We transmit it at the time that the conditions are cleared.
So when you're talking about cycle times, it's something that you need to factor it in. Greg, give us an idea of cycle times or turn times on local USDA offices. What's the best one? What's the worst one that you see right now?
We've got, and Brenda can help out as well, I think Louisiana, Florida, Alabama tend to be pretty consistent, 3 to 5 days. The best one we've got is up in Iowa. They usually give us same day to next day turnaround time. It all depends on just like just like Fairway, towards the end of the month, and you've got a lot of loans trying to get the closings done. The new submissions may go out a little bit farther, and so, or they have a big influx at any particular point in time throughout the month or throughout the year. Those cycle times will increase. But Texas has typically been the harder one. It typically is, upwards of a good time turn time in Texas is usually when it gets down to a week. Otherwise, they're usually.
We have one that we're waiting for now from Hawaii that's been there since 7/31.
Okay. So you know, a couple of things. One thing, let me clarify Greg's comment. Not just like Fairway. We are one step ahead of that surge, right? But it's all dependent and relative to time of the month, as well as overall activity. So, you know, if you're in Hawaii and you know that you got a potential 2.5 week lag time on that, it's just something to take into consideration. USDA may not be consistent with, you know, that whole quick close concept that I talked about just a minute ago. But, you know, when you're in a market and your USDA office is, you know, like Iowa, and they're reviewing them same day, it really doesn't change your workflow. Again, just something unique to the USDA loan that you need to be aware of. I would strongly encourage you to develop the relationship with your local USDA office. You know, I see those offices very similar to, you know, our regional VA offices, where those individuals employed there, you know, have an initiative, and it's all about promoting the program. And so, you know, you get a good working rapport with those, you understand the way they operate, the flow, and it arms you to, you know, to be successful with the loan program. All right, before we get into program highlights and dig into details, I see we do have a couple of questions in here. I go ahead and read them, and Greg or Brenda or Lonnie or Judy, anybody want to help me answer them? So that I thought we could only roll up to 2% over the sales price and appraised value. Is there still a 2% cap on that?
No, there's not. It's all allowable closing costs and prepaids can be rolled in up to that sales price. So if you got up to that appraised value. So if you got a sales price of $100,000 and your appraisal comes in at 105, and you've got $5,000 worth of closing costs that you can roll in, you can do that.
But the guarantee fee can exceed the appraised value, right, Greg?
Correct. And once you get to what your loan amount is, you can add the guarantee fee on top of that. So in the example, if you've got $5,000 worth of closing costs and prepaids that you're rolling in, and you're doing a base loan amount of 105, you then can roll in your guarantee fee on top of that.
All right, U.S. citizen only, or can a resident alien get a USDA loan?
Resident aliens can as well. When you're running your loan through GUS, there's a place, you need to have their documentation before you submit the loan through GUS, because GUS will require that you input the type of documentation that you're using, and it goes out to a website. I think the acronym is SAFE. It's a government website. It goes out, it checks that information and returns and tells you if your borrower is valid, is acceptable for the program.
All right, then one more. Can you confirm if there is a loan limit for each county for the program, or is it only income and property and ratios? So I think I'm reading a couple more that are coming in. I think we're going to cover these as we dig into these items. So I'm going to leave these standing right now, and we'll come back and stop a couple more times as we move through this and see if we don't answer these questions as we go through the presentation. So first thing we want to talk about is, you know, or really focus on when we're talking about the USDA is what are the types, what are the transaction types out there? Okay, and again, some people may think it's only a purchase and it can only be a first-time home buyer, inaccurate. Okay, in fact, USDA has expanded their product offering over some of the recent years and trying to give us a level playing field for some of the other government programs out there. You know, the FHA Streamline, the VA IRRRL, you've got somewhat of a streamlined refinance program. But purchase, non-streamline refinance, streamline refi, and then there's streamline assist.
Yeah, so as Al mentioned, we're going to try to stay at a high level. The slides themselves go pretty deep into a lot of the highlights, not only the highlights, but a lot of the guidelines. What we'll try to do as we go through this is pick out the highlights of the highlights and allow you to ask the questions if need be on individual situations and scenarios, but we'll try to keep it at a high level and just hit like I said, the highlights of the highlights. On a purchase loan, they offer a 30-year fixed rate. There are no other terms, ARMs, 15 years, any of that kind of stuff. It's straight up 30-year fixed rate. You do need an appraisal. The thing to be mindful of is it has to be, for Fairway, we ask that it be an FHA rostered appraiser, because the appraiser has to, just like an FHA loan, must specifically state that the property meets HUD's minimum property standards and requirements per handbook 4000.1, and that, we feel that an FHA appraiser is the best qualified to do that, and so we ask that it be an FHA rostered appraiser. No down payment is required. No reserves are required. I saw a question in the box about allowing a DPA. We do allow DPAs. You don't have to take the full 100% loan to value. They can take advantage of DPAs. Gift funds, you rarely need them because you're allowed to go to 100% LTV. As Al mentioned earlier, it's got to be run through GUS, but we are able to manually underwrite. The big thing to remember on credit history with USDA loans is they're the only ones left with a minimum trade line requirement. The borrower must have at least one applicant on the loan has to have 2 trade lines that are reporting for at least 12 months. Student loans where they haven't made the payment and they're deferred, if they've been deferred for 36 months, they don't count towards that 12 months. It's 12 months worth of payments. You can use non-traditional credit to establish those 2 trade lines, and that becomes a manual underwrite, and we will need the housing payment history to go along with that. Again, DTI is if you're looking for an accept, if you get the accept through GUS, there is really no DTI limit. We typically don't see many GUS accepts, though, up above 45, kind of like the old standard that we saw on Fannie Mae before they made the change last month. When you've got strong compensating factors, in particular, one of the big ones is credit score, and the other big one is a reduction in their current housing. So if they're renting for $1,000 and they're going to buy a house where the payment's $900, that's a great compensating factor. We typically don't see many waivers, though, with ratios of above 43%. And we'll touch on this a little bit later, but there's really 3 types of income that you've got to be aware of: the annual household income, adjusted income, and repayment income. We'll get into that a little bit later. Al's already touched on the guarantee fees. We touched a little bit on the loan amount. The LTV being based on the appraised value, not based on the purchase price. The guarantee fee, and we'll get to it a little bit later, I think, the way it differs from FHA and VA is that your guarantee fee is based on your final loan amount. So you kind of have to back into it, as opposed to it being based on your base loan amount. So if you got a $100,000 loan and the 1% guarantee fee, it's not just automatically $1,000. It's actually going to be a little bit more than that, because it's going to be based on the final loan amount that you have. But again, just one of the quirks that we'll kind of touch on a little bit later. We've talked a little bit now, and we'll get to the maps that Al mentioned. The property needs to be within, say, the eligible areas, 1 unit, condo, PUDs are all acceptable, must meet HUD's minimum property standards.
All right, Greg, a couple questions come in as we're looking over these highlights, guideline highlights. So go back to the loan amount real quick, and what if sellers are paying the closing costs, then we get the appraisal that allows to roll in the $5,000? Is that okay with USDA to change during the process?
Yes, but at the end of the day, if I may not be understanding the question correctly, but if I've got a $100,000 purchase price with the seller paying $5,000 in closing costs, and the appraisal comes in at $105,000, when we make that change, aren't we going to do a dollar-for-dollar reduction in the seller paid closing costs equal to the reduction in the purchase price, right? So either way, those funds are being financed into your loan. So whether we say a $95,000 purchase price on a $100,000 purchase and the loan, and we roll the closing costs in with that extra $5,000 room, or whether we have a purchase price of $100,000 and the seller pays $5,000, it pretty much washes, right?
Sounds like it. One other question: reserves. As far as manual underwrites, there is a reserve requirement when it's downgraded and goes through a manual underwrite. Is that accurate?
No, there is no reserve requirement even on a manual. That's an FHA requirement. FHA does require 1 month's reserves that USDA does not. Now, a lot of times when you're doing a manual underwrite, though, you're dealing with a need for a credit waiver or a ratio waiver, and reserves are a good compensating factor for both of those.
Great. All right, as we move, I believe we're moving out of purchase transactions. Greg, real quick, high level, talk to us a little bit about the difference of the non-streamline refi versus the streamline refi versus the streamline assist. I know we're going to go into each one of these in depth, but just real high level.
The biggest difference is, I guess, first off, USDA, all of their loans, all their refinances require that the underlying lien be a USDA loan. So they're all a streamline in the sense of, you're paying off a current underlying lien that's with USDA. The biggest difference then between them all is that whether you can roll in just the principal balance, roll in the principal balance and interest, and whether you can roll in closing costs as well, and then with that, whether you need an appraisal or not.
So let's start with the non-streamline refinance transaction.
Yeah, as it mentions, an appraisal is required on those. It is run through GUS. It's fully credit qualifying. You can add borrowers. Closing costs can be, closing costs and prepaids can be rolled in. Same credit requirements that you have on purchase transactions. I skipped over assets. In this case, on that loan program, on the non-streamline, you have to verify the funds to close the loan. Yeah, their assets must be verified.
Anything unique?
Go ahead.
No, I was just going to go ahead.
Yeah, really, a non-streamline refinance pretty much follows your your purchase transaction, as far as your DTIs, your assets, your employment verification, that kind of thing. The guarantee fee is not different on any of these transactions. We do require at least 12 months on the existing USDA loan, and current for the 180-day period prior to the loan application, and any lates within the last 36 months have to be addressed. The maximum loan amount, same as the purchase, 100% of the appraised value plus your guarantee fee. And then as it lists there what you can roll in, your principal and interest, your closing costs, and your prepaids. Again, same thing, max LTV. All USDA programs are primary residence only, and they do not allow for non-occupant borrowers at all. Again, as I mentioned, requires payoff of an existing guaranteed loan. We can't pay off an FHA or a VA or anything else. The properties have to be located in a this is if the property originally had to have been in a USDA eligible area. Subsequently, if those areas change, the borrowers can still do a non-streamlined refinance in those newly ineligible areas.
And you already mentioned the 12-month seasoning.
Right.
So shifting from the non-streamlined to the streamlined, I see that the biggest one that jumps out at me this page is no appraisal required.
Right. Yeah. And it says it must be run through GUS. That's incorrect. I don't believe the streamlined refinances need to be run through GUS. Is that correct, Brenda?
That's correct, Greg.
So when we're doing a streamline, it is not run through GUS.
Correct.
All right, we'll update that before we send these out to everyone.
Yeah, same idea as far as what closing costs can be charged, minimum credit score, minimum trade line requirements, those all remain the same.
Everything as far as DTI, employment income, guarantee fees, all of that can be the same as well.
Right. And the key on the income is it kind of gets interesting because you have to provide the income to evidence that the borrower is within the income limits for the county. So we've got to have the income documentation. I think there was a question earlier about the loan limits, and they don't have a loan limit. The way that USDA restricts your loan amount is by the fact that they have income limits for the county. You know, so if their income limit is $80,000 a year, then it's hard to qualify for a $500,000 loan within that county, right? So that's how they limit their loan amounts. They don't per se limit loan amounts; they just limit the income to the area. As you can see, same thing with the streamline. You got to pay off an existing guaranteed loan. Can't be a conventional FHA, etc. And again, still the 12-month seasoning requirement.
So if I'm an originator, just as participating in this webinar, and I've been following along, why wouldn't I do a streamline on every refinance transaction? Why a streamline versus a non-streamline? We see that the difference between the two was the requirement of an appraisal. But tell us when someone would use the non-streamline versus the streamline.
The income and credit piece of it. The income piece of it that I did. And actually, go back and let's see, because I'm thinking. I don't have a good answer for you.
All right. So, well,
the streamline, because we've got on our slide there that you can roll in closing costs and prepaids.
And you think that's probably dependent upon an appraisal?
Right.
Appraisal on the streamline?
On the non-streamline. Allows us to roll in the closing costs and prepaids. So you've got the non-streamline, we've got the streamline, and then Greg, what's the difference between the streamline assist?
The streamline assist is where you would no longer need your income and asset documentation. So you'll have and no appraisal. So with the streamline, you still need your income documentation. With a streamline assist, you don't. And you don't need a full-blown credit report. You only need the mortgage payment history. We don't calculate the DTI on it. We just, again, that's where we get a little conflict. Okay, well, you don't want your income documentation because you're not going to calculate my DTI, so why are you asking for pay stubs and W-2s and tax transcripts? Well, because we still have to make sure that they meet the household income limit for the area. And the maximum loan amount on these, principal and interest on the existing loan, eligible loan closing costs, funds necessary to establish the new tax insurance. There is no max LTV, obviously, because there is no appraisal. Again, primary residence is only. Existing USDA loan has to be the one that's being paid off post 12-month season required.
So it sounds to me very much in line with what we see with FHA, the streamline, the credit qualifying streamline, the not versus the non-credit qualifying streamline.
Right. Their standard streamline would be a credit qualifying streamline. Their streamline assist would be your true FHA streamline.
And the only one of the three refinance programs that requires an appraisal is going to be our non-streamline, correct?
The streamline does not require an appraisal either. So the only one that requires an appraisal, sorry, I misheard you, is the non-streamline.
All right, anything else on our comparison chart before we move off of the loan program types?
Yeah, so on the comparison chart, there's your answer to your question earlier about the non-streamlined and the streamlined. We're going to have to correct that slide on the streamlined. You'll notice that on the streamlined, you can only roll in principal and interest and the upfront guarantee fee. You can't roll in your closing costs and prepaid. So that's where I was thrown. So it is the non-streamlined versus the streamlined. The biggest difference is rolling in your closing costs and prepaid.
I would say vast majority of the USDA transactions that we do are purchase transactions. But I think as you're getting introduced, or maybe you do a lot of refinance purchase transactions. You do a lot of USDA purchase transactions. Another product in your arsenal is knowing that you've got 3 versions of a USDA refinance transaction. Let's see, a question is this similar to a VA IRRRL? It looks exactly similar to a VA IRRRL. Again, I think Greg mentioned it, that we're not using income to validate qualifying from the standpoint of credit qualifying, but we're looking at it from the standpoint of income restrictions. All right, moving on. So we've talked about the programs, the actual program type. All right, moving on. Hang on. Okay. Let's go into borrower eligibility. And I made a comment earlier that U.S. citizen. However, we do have certain non-U.S. citizens, qualified aliens. It goes really to the primary highlight of this slide would be, as Greg already alluded in every one of the transactions, it's the primary residence. When you participate in USDA sessions, they focus on, sorry. They focus on borrower eligibility, being a borrower that cannot be eligible for conventional financing. And when you think about that, well, some of them, you think they potentially run this test when they say cannot be eligible for conventional financing. They run the test of a 20% down payment availability. Okay, and you kind of look at the third bullet point, that ratios cannot exceed 2836 with a 20% payment. Assuming a 20% down payment is being applied at the time of time of closing. So, Greg, you got any comments about this? Do you actually look at each borrower and say, are they eligible for conventional financing, or do you really look at it from the standpoint of the income and the max income and the eligibility requirements per USDA? Give me an idea from an underwriter's perspective how you look at that borrower eligibility.
As it mentions on the bottom there, the applicant must meet all 5 criteria. So the very first, as an underwriter, the very first thing we're going to look at is assets, right? The rest goes out the window if the borrower doesn't have 20% down payment available. So the first look and easiest look to know if they meet the test is their assets. Most of our rural development USDA loan participants don't have a lot of assets, and so that takes care of it pretty quick and easy up front. If we have a sufficient amount of assets, a 20% down available, then we do go down through this list, through each item, and determine whether the borrower meets it or not. Very seldom do we ever find a borrower who meets all 5 criteria. If it's not assets, then most times it falls to ratios.
Would Gus let us know when we run a Gus? Would it let us know if it is not eligible because they're eligible for conventional financing, or is that strictly an underwriter's assessment?
Strictly an underwriter's assessment. And again, the biggest thing is the assets. So a lot of times you'll hear, the myth is that if they have 20% down payment available, they don't qualify. That is a myth. They've got to meet all 5 criteria. So, when you've got that borrower with a 40% back-end ratio, they don't qualify for conventional financing per USDA's definition, and we can do the loan still, even with the assets.
All right, so as far as the dwelling is concerned, we've talked about it has to be a primary residence. Now, talk to us a little bit, Greg, as far as if they have an additional property or a dwelling, can they get USDA loan?
They can. I'm not real familiar. Brenda might be better to address it. I'm still from the very old school and haven't had a lot of these where they already own another dwelling come up. As you see on the bullet points there, in order to do it, they have to the current home or the home that they currently own can't meet their current needs. So they define that as more than 1.5 household residents per room. That includes doesn't include your hallway, foyer, bathrooms. So it used to be a little more difficult to qualify under this because there wasn't a definition. So one person who says, you know, my 2 children in one room doesn't work for my family, it's more defined now, 1.5 household residents per room, or a person who has a disability and limited mobility, and they can't, you know, it's a 2-story home and they can't get up and down the stairs. It wouldn't adequately meet their needs now. But the main thing is that you evidence that it no longer meets the applicant's needs.
Okay, shifting gears from borrower eligibility to property eligibility. As I mentioned earlier in the call, some of you that aren't currently active in USDA lending, you'd be surprised how widespread property eligibility is in a lot of areas. We do have a link within the presentation. I do have a couple of, I do have it pulled up already. So here's our link to the property eligibility. We would click on single family and then property eligibility, and it draws us to a nationwide map. And then you can drill down. All of the shaded areas are year ineligible. So, you know, for those of you who are in the southeast, you can see outside of some of our major MSAs within the states, you know, Atlanta, Montgomery, Opelika, Birmingham, Huntsville, all of this area. You know, we look over at Texas, and we've got a lot of business coming out of Texas. Really, when you get outside of Dallas, Fort Worth, outside of Houston, all of this, the unshaded areas are eligible for USDA financing. And again, I think this map helps paint a picture that this program is much more accessible and available than I think a lot of individuals focus on or would know. You know, you think USDA, you think of, you know, really rural areas. Well, you know, there's a lot of areas that you're looking, those of you familiar with the Texas market, a lot of areas in there that I wouldn't necessarily classify as rural. So the map, take some time to go through the map, click on it. It's included in the presentation, and look at your markets. You know, look at the markets that you're in, and know, you know, what properties are eligible, so you know whether or not USDA is a viable product. You can actually go into in that property eligibility and drill down and put an address in there, and you know, determine this address is located in an eligible area. So, you know, maybe if you're closer to some of those city limits, and you can see, you know, this screenshot right here, there's some spotty areas that are and are not. So you can put your specific property address in there and determine property eligibility. Condos. Greg, do we do many condos?
We don't see a whole lot of condos just by the nature of where the majority of the loans come from. The key on those, as long as they are Fannie, Freddie, HUD, or VA on one of those approved lists, they're eligible.
We have some unacceptable. Go ahead.
Yeah, the key on a USDA loan is this no income producing buildings and no income producing land. Again, it's got to be an affordable housing program that is looking to provide home ownership, and so as you get into rural areas, though, you may have quite a bit of tillable land or something that may be considered income producing, and that is not acceptable for USDA. One thing that we'll run into is occasionally is multiple parcels. If that property can be subdivided because of the multiple parcels, for example, that the ability to sell a piece of the land is considered income producing. That would make that ineligible.
I've seen a couple questions pop up on things that we just covered. There was one specific to ask Brenda. What would need to be provided if a manufactured home is fixed to prove whether or not a manufactured home is fixed or non-fixed on a permanent foundation?
That would be based on whether the mobile home is taxed.
Now,
As a real property and not just as a mobile home?
And I know Brenda's really familiar and can help you with this, but one thing, and it may be on the next slide, Fairway does not do manufactured homes within our wholesale group, so we wouldn't be able to facilitate that loan for you. But Brenda, go ahead. You can definitely help him plan and structure that.
So the question was, what makes it a manufactured home?
What documentation would need to be provided to prove whether it's fixed or not?
To be able to purchase another property?
Correct. I think we go back to, we go back a couple slides here.
Oh, I get the question. I'm sorry. I jumped the gun by saying we don't do them. That's not the question, is it? It's the fact that that previous residence is not adequate housing.
Right there.
Okay. If not,
I think that, correct.
Yeah. Okay. If it was in fact fixed to a permanent resident, it would be assessed as a permanent property and not as as temporary. They would be paying taxes on it. So it would be considered as a permanent foundation.
And if it was fixed on a permanent foundation, it would not be eligible to purchase another.
Correct.
Okay. Todd, let me know if that doesn't answer your question. We can come back and drill on it. And then Gene asked, when doing a refinance, will the program allow subordination of a HERO or PACE loan?
The guidelines are that obviously on the streamlines there is no appraisal and no loan to value calculation. The guidelines do say any existing subordinate financing, any existing secondary financing must be resubordinated. So that would indicate that, yeah, as long as it's on there currently, it can be resubordinated.
Good. All right, Greg, you want to touch on, I know we've got 3 slides here and they're full of information, but talk about the water systems. Water systems,
so
waste systems.
If it's not a public water system, then a water quality test is required. And it outlines here what those requirements are as far as the period in which it has to be performed. When a water test would expire, that kind of thing. Basically, you're following, as far as a well and septic, the same guidelines that FHA does. Because again, we're certifying that the property meets HUD's minimum property standards per Handbook 4000.1. Cisterns aren't acceptable. Key is getting the water quality test.
Talking about
very similar to FHA. Did you have a particular question, Al, on it?
Nope, I was just transitioning into the shared water systems.
Pretty much same as FHA. Must have and all those guidelines there. All that information is FHA, mirrors FHA. Separate valve on each dwelling, adequate for all the families that are served. And again, same thing. You're going to have anytime you're dealing with a private system, you need that water quality test to show that it meets the EPA standards. And if it's shared, then you got to have that well agreement that dictates who's gonna maintain it, kind of like a private road maintenance agreement. Same thing, a private well maintenance and maintenance agreement. Yeah. As far as the waste systems, those no longer have to be tested as long as the appraiser indicates again that it meets HUD's required handbooks. So the key is that your FHA rostered appraiser certifies that the property meets HUD's minimum property standards and the privately owned waste system is acceptable.
Okay, so moving out of property, so we've talked about borrower eligibility, property eligibility. I know we're coming up on an hour. Just to give those of you on the call an idea of what we've got left, we're going to cover real quick the income eligibility. Just dive into income a little bit, and then we wrap it up with talking about GUS. So we probably have another 15 minutes. Again, those of you who might have to drop off, we will get these slides out to you. For everybody else that can hang with us here, we'll keep moving. So income eligibility. I'm going to let Greg jump into it and dive deeper, but I'm going to talk, just from the high level. We're looking at, again, maps, and we go back to the website real quick. And this is the same screenshot you're looking at right now. You're going to be able to drill down into, say for Alabama, we can drill down into areas, and based on the number of persons in the household, now you see, income limits. Okay, you can go through it that way, or we can actually go through it going through the screens that we have within the USDA website, and you can drill down into a specific area, county. And you'll see it's asking number of persons in the household, number of folks under 18, and it's asking some qualifying questions. So it's going to drill down into telling you exactly what the income restrictions are. Again, we had these slides. I just wanted to show you that these are both under the same website, and this is our USDA website, single-family housing. We touched on the map just a second ago under property eligibility. And then now we're over here on income eligibility, income limits.
As you mentioned,
go ahead.
There's really three types of income, the two major ones. Your household income, which is the income you're going to base the charts and things off of to see if their income is within the county loan limit, county limits for the place the property is at. That is the household income for all adult household members, non-borrowing spouses, boyfriend that lives with them, grandma that lives with them. All income is included in that household adjusted income. Qualifying or is your repayment income that's only going to be represented by your borrowers on your loan and their ability to repay. And I think the future slides will dig a little deeper into that different household income calculation. The key to understand on this is USDA on the household income wants you to project forward For example, we have a non-borrowing boyfriend who was on the loan we were just doing. His 2016 W-2 showed $7,000. You can't just use it, but his year-to-date pay stub that he had been on the job for 2 months showed $2,000. USDA would require that you take the 2-month average of that $2,000, which is $1,000 a month, and apply a $12,000 hit, or apply $12,000 as his contribution to the household income. So household adjusted income, they're going to want to project forward, and they're going to use, so to speak, worst case, a higher dollar amount based on those calculations. Qualifying or repayment income is going to be your standard, just like FHA or conventional, and will probably be a much more conservative number than your household income is. Within that, after you calculate that adjusted household income, there are some deductions you can take to reduce that dollar amount. Any dependent is automatic $480 off. Child care expenses can be deducted for children under 12. Elderly household deduction for those 62 years or older. Medical expenses, that kind of thing. That all has to be documented and supported by the tax returns in order to deduct those expenses. I think these are the slides that show what Al was just going through as far as where to find what those limits are, just in general what the limit is, and then this site that Al went through that actually will calculate your adjusted income and tell you whether it meets the restriction for the county or not.
So these are just walking you through the slides that ultimately you're doing the data inputs that Greg just touched on. And here we get, Greg, this is real live accurate information that they can depend on, correct?
Sorry, ask that again, Al. I had an interruption here.
This is real-time information as they enter this information and go through these screens on the USDA website. This is information as they calculate that they can rely on this information, correct?
Correct. As long as as long as their data input is accurate, this is accurate. That guaranteed housing program limits that show up are the true limits for the county. USDA used to be every single, for one person, this is your limit. For 2 people, this is your limit. For 3 people, this is your limit. They did away with that about 10 years ago and made it so that it's just, 1 to 4 is this limit, 5 to 10 is this limit. So as long as you've got the right number of household members between 1 and 4, this is the 78.2 for Jefferson County is the 1 to 4 limit. If you've got 5 people in your household, this would be inaccurate. So just make sure the data input's accurate. Repayment income, it's very, again, as I mentioned on that earlier slide, it's your standard computations, it's your standard documentation. There's always, the scenarios and questions of, well, if she's been on the job this long or that long, how do we calculate it? But it's very standard to your FHA income calculations and requirements as far as time on the job, that type of thing. So I don't know if we want or need to hit on every single item, but again, they typically want a pretty conservative calculation.
I think for sake of time, again, you've got about 4 or 5 slides here on repayment. Down at the bottom here, I see that we talked about the retained property earlier in the presentation. So I think each one of these slides is really going to drill down and give you some helpful information. We'll go through them. Greg, feel free to.
Yeah. So while you're on this slide, sorry to interrupt. The assets have to be counted in the household income calculations if you've got more than $5,000 in assets. Basically what you have to do, you got to figure out what the local savings rate is currently and apply that to their $5,000. Typically this isn't going to be a deal breaker unless you've got somebody with a lot of money that you apply, because local passbook savings rate right now isn't much. You're lucky if you're getting 1 to 2%. So just to be aware, though, if you've got assets, you're going to have to count the interest earned on those assets towards your household income limits. And like you said, nothing really. As you slide through them, I'll jump in, or Brenda can jump in if there's something that needs to be discussed on them. Goes through the fact that you're going to take your year-to-date, get kind of the idea that I mentioned on the household income, go through your year-to-date. Historic, I guess that's the biggest difference. Repayment is going to go off historical. Household income is going to go off of projected. Not much on other forms of income. Obviously, if anybody has specific scenarios or questions on any of these types of income, please go ahead and ask the question in the ask box or get with Brenda or myself after the presentation and we can address them. Documentation, again, pretty standard, same way you would FHA. A full written BOE and a pay stub, or pay stubs and 2 years W-2s, that type of thing. Self-employed does always require 2 years tax returns and always requires a year-to-date profit and loss. Year-to-date profit and loss, obviously, in order to project forward on your household income, we got to know where they're at year-to-date. And I don't know if it's addressed in a future slide. USDA requires tax transcripts on every transaction for every household member. So if you've got a non-purchasing boyfriend who's going to live in the home, or a grandma who's going to live in the home, you're going to have to obtain their tax transcripts as well.
So while Fairway updated our tax return transcript requirement here recently, at the beginning of this month, matter of fact, USDA, as Greg just alluded to, still does require tax transcripts. So, Greg, how explicit is Gus' finding as far as, when I look at these 3 options, does Gus, is it as explicit as DU feedback when it comes to what income documentation we're required to provide?
Yes, it's specific and gives all these options. Asset documentation, you always need the 2 months bank statements. One thing, again, because there's 2 things at play with USDA, that we're going to need your asset documentation all the time. For one, they're looking for any deposits, because those deposits can indicate additional household income that may not be indicated anywhere else. So you've got your what are those called, Etsy accounts or whatever, and you've got this occasional money coming in. That's household income, and so we've got to have the bank statements for that reason. A lot of times we won't get a bank statement. You'll say, well, we don't need to provide, they don't need the funds. Well, if they have a bank account, technically per USDA, you've got to verify all your assets for for the household income piece in case they've got $5,000 worth of assets. So if they wrote a earnest money check, we know that they must have a bank account, and you're going to have to provide the bank statements for that account.
Okay, so we're shifting out of income and asset documentation, and again, the last couple minutes here of the presentation. Just a reminder, we already talked about this at the beginning of the presentation as far as the upfront guarantee fee is concerned. USDA does changes from time to time. I believe it was as high as where were we, Greg, 2.5?
Yeah.
And these changes went into effect last year, wasn't it? Down to 1%.
Yeah, they're slowly lowered it down to 1.75 2 years ago, and then every year they revamp it about October. They'll come out and tell us whether they're changing it.
The October time frame, I don't see that we do cover this, but I'll go ahead and talk about it real quick. Is USDA's fiscal year runs from October to October, and as we approach that fiscal year, there are the government actually has to reallocate funds for the USDA loan program, and in some cases we've seen in years past some lenders take the stance that until that reallocation is complete, they don't fund USDA loans. Fairway has never taken that stance, and I'm not going to say never will, but we have not taken that stance, and we keep rolling through it when we get close to the end of that fiscal year, regardless of where the government is on reinstating funds for the next fiscal year.
Yeah, we just maintain business as usual and fund those loans.
Well, the only difference that happens when that does occur, that the conditional commitment comes out with with some specific verbiage referring to the reservation of funds. So again, it's business as usual in those instances. I just pointed out because that is something that happens every year, and again, different lenders take different stances on that. So. Gus, we already talked about Gus. If you do USDA business on a regular basis with Fairway, we want to give you access to Gus. Basically, you gain access to Gus through your lenders under a sponsored type access. So you would have to fill out a form. We have this top form right here, Gus registration form. It's posted on our website under forms and documents. You'd fill it out and submit it, and we'll go through the process of getting you set up to where you can access Gus. Because if you don't go through that process, then in effect we're following number 2, where you're having to complete a Gus submission on the loan level. So again, if you're going to be doing any reoccurring USDA business, we strongly encourage you. We know how, as the broker and correspondent community likes to control that origination process. You don't have to wait on us to run that. It's not that it's a huge time frame, but when you can control it, we always see the benefit in arming you with the tools that you need. So Gus is available to you. If you want to do it, go through the Gus registration process. If not, then no, on the loan level, you need to get your 3.2 uploaded into our website, and then you need to complete this form and submit the form. They do have training sessions. Again, USDA does a great job on training, similar to the other government agencies. They really promote their program, and they're there to help us understand their program so we can do more of their program. So there's training sessions out there for you. I will always remind you that Fairway is very willing to do any individual training with you. Should it be on anything that we've covered. But if you've never done Gus on your own, you say, hey, we're going to do a couple USDA loan transactions every month. Let's go ahead and get Gus. Let's go ahead and get access to Gus. We can help you get comfortable with running those Gus submissions. So I talked about the forms and documents. This is the main landing page when you log into our website, forms and documents. There's a couple of forms that are consistently requested for USDA. Outside of what you see right there, Greg, anything else that is unique to USDA from the standpoint of forms, documentation, disclosures?
No, the 3555-21 is the most unique of the documents. Basically, it is your the equivalent, I guess, of your FHA-BA addendum to your loan application, and it must be signed by the borrower. So you'll want to be that's the main one to be aware of, because you'll need it up front to have your borrower sign. They sign page 2, and you can leave your signature area, the lender's signature area blank, and your underwriter will sign that section. We do want these as completed as possible. Really, page 1 is very important to us. It's got a few questions about whether that help us with household income. Whether they're over the age of 62, and whether they've got disability, whether they're veterans, that kind of thing. Where it says important household income must be recorded on page 3 of the form. It's important to make sure that you've got all of the household members on it. We'd be more than happy to complete the household income information section as long as you've got all the household members on there. Sorry, long answer to a short question.
No problem. And again, that forms and documents section is where you'll find the registration form or the Gus request form. Guidelines, anything that we've covered here, again, it's either been pulled directly from a USDA training session or Fairway's guidelines, which are posted and accessible to you. So if you click on that guidelines tab, it will launch what we refer to as Knowledge Owl. Knowledge Owl is the actual platform that houses our guidelines. And I like to tell most people it's easiest from my perspective to drill down into wholesale product matrices, because then that gives us the second screen right here to go straight under USDA products. Okay, and it's just a very easy entry into one of those 4 product categories. But again, everything's posted on that platform, which is accessible to you once you log into the web page. These are the top 4 icons on the left-hand side. So that's a great resource for you. A lot of information through our guideline platform. But don't ever hesitate to send any scenario through our Ask Desk. That's exactly what the Ask Desk is for. It's manned by our credit policy team. They take your scenario and they try to drill down and scrub it against the guidelines and give you feedback unique to your specific scenario. Several different links, resources, things that we've talked about, handbooks, income eligibility site, income limits, property eligibility site, your Gus training course, the wholesale lending guideline platform. Reminder, really you need to access that wholesale lending guideline platform through our web portal. Once you log into the website, you're no longer required to log into the web or the guideline portal as long as you link to it through there. There's your ask email address, ask@fairwaywholesalelending.com, and then a reminder on any product pricing or rate needs. Go through our Ask Desk. So I'm looking through the Ask box, or sorry, the Ask box. I'm looking to the question box right here, and I believe it looks like Melanie, you might have asked a question, but will you have the essay comment repeated?
Yeah, that was just a kind of off the cuff. But when we see a bank statement, a bank statement with any deposit Most of us are used to the Fannie Mae definition of a large deposit, FHA's definition of a large deposit, and so on USDA, it's any deposit, because that deposit may reflect or be indicative of additional household income. And I just used Etsy as an example. You've got a $3.50 deposit to your bank statement, and you're saying, Greg, why in the world are you asking for a $3.50 deposit to be verified or explained? Well, because if it happens to be a regular business or a small business that they've got on the side that they're running through Etsy or their eBay account or something, again, just selling something one time when I had an extra whatever laying around the house and I sold it, that's fine. We can live with it. But if it I've got this small business on the side that I sell trinkets on Etsy all the time, well, we're going to need a P&L, because that's household income that we need to include in our household income calculation.
I'm glad you knew what Etsy was, because I was unfamiliar with that acronym. All the mortgage acronyms we got. So
ask your wife.
You're right. Just in conclusion, I appreciate you guys hanging in here with us. It looks like we kept the vast majority of you guys on past an hour. I know this is a lot of information for some of you. It's just a refresher. I saw someone go through the question box that I've been doing these for years and I never knew that. So some of you, it's just a refresher. Hopefully some of you are seeing the USDA product for the first time and you're saying, I can use this. Borrower eligibility, property eligibility, income restrictions, unique underwriting platform. You got your guarantee fee, and then the fact that there is a slight variation to the workflow in that we've got to go to our local USDA office. So I mentioned it once or twice throughout this presentation. Fairway is here for you, to support you in any way. A lot of you who are new to Fairway know who Christy Rich is. She helps with our onboarding of new clients. She also does a lot of training sessions. Christy put this webinar together for us, and so I included her name on this last slide so that you're able to reach out and ask for training. We're here to help you get comfortable with this. It may be something new, but give it a time, give it a loan or two or three, and before you know it, you feel comfortable with the process, the ins and outs of the program. Greg Reynolds, that's our underwriting manager. You heard from Fairway Wholesale Lending's underwriting manager, and hopefully you heard the same thing that I heard, is a willingness to look at ways to make loans happen. That's what this program is all about: low to moderate income lending. So. Again, I know we invested some time today. Thank you for giving us the time. Thank you for the continued relationship. Don't hesitate to reach out to us. We will get this presentation out to you this afternoon, and feel free to if we didn't answer your questions or you want to go a little deeper in any questions that you had, feel free to respond to that blast, because it'll be coming from the Ask Desk. So. Here to help you in any way. Thank you for continued business. Fairway appreciates you and appreciates your staff. Have a great afternoon. Go do some USDA loans.